reached a 7-year low of 3.8% in March 2018 before increasing to 4.5% in April as the impact of the VAT increase and other levies became evident. Goods price inflation increased from 2.6% to 3.5%, while services price inflation increased from 5.1% to 5.3%. The bank's measure of core inflation, which excludes food, fuel, and electricity, increased from 4.1% to 4.5%. Year-on-year producer price inflation for final manufactured goods declined from 4.2% in February to 3.7% in March. The headline inflation forecast of the SAB is more or less unchanged since the previous meeting of the MPC, despite upward adjustments to the international oil price assumption and a weaker starting point for the trade-weighted exchange rate. The impact of these adjustments on the inflation forecast was offset in part by a lower food price forecast and a lower starting point. This follows a succession of downside surprises in core goods and food price outcomes. The forecasts for 2018 and 2019 are unchanged at 4.9% and 5.2% respectively, while the forecast for 2020 is marginally higher at 5.2% compared with 5.1% previously. The peak of 5.5% is still expected in the first quarter of 2019 before the impact of the VAT increase largely dissipates. The forecast for core inflation is marginally lower at 4.5% for 2018, but has deteriorated somewhat more than the headline inflation in the coming 2 years to 5.1% in both years from 4.9% previously. A peak of 5.2% is expected in the first quarter of 2019. The implied starting point for the rand in the forecast is 12 rands 37 against the US dollar, compared with 11 rands 97 at the time of the previous meeting. Food prices, by contrast, are expected to increase by 4.9% in 2018 and 5.5% in 2019, lower than in the previous forecast. There is a degree of uncertainty regarding the likely impact of the VAT increase and the sugar tax on food, and the extent to which these increases will be absorbed by manufacturers and retailers. Following persistent increases in international oil prices since February, the assumptions for Brent crude oil in the model were revised upward by $7 per barrel for each year to $70 for 2018, and by $5 per barrel to $67 for the next 2 years. Both the futures markets and consensus forecasts indicate some moderation of prices over the next 2 years. Inflation expectations of market analysts reflected in the Reuters Econometer survey have moderated somewhat since March. In the May survey, median inflation was expected to average 4.9% in 2018 and rising to 5.3% in 2020, compared with 5% and 5.5% in the March survey. Expectations implicit in the break-even inflation rates, that is the yield differential between conventional and inflation-linked government bonds, are more volatile and sensitive to exchange rate movements. These expectations show some increase following the recent rand weakness, while the longer-term expectations are back above 6%. The 5-year break-even rate remains within the target range. The next BER inflation expectations survey will be published in July. The global economic backdrop has become more challenging amid continuing trade policy tensions between the US and China, as well as other geopolitical risks. Although the economic growth outlook in the advanced economies generally remains positive, there are signs that the momentum may be slowing. Global inflation remains on a moderate upward trend, but still at low levels. However, rising international oil prices could derail the relatively benign global inflation prognosis. Since the previous meeting of the Monetary Policy Committee, the rand has depreciated slightly against the US dollar in particular, reversing much of the overvaluation seen at that time. Since then, the rand has depreciated by 6% against the US dollar, by 0.7% against the euro, and by 2.8% on a trade-weighted basis. The main driver of this recent rand weakness has been developments in the US financial markets, where treasury yields exceeded 3% for the first time since July 2011. This was in response to wider fiscal deficits, rising inflation expectations, and expectations of further US monetary policy tightening, a key risk highlighted in the previous MPC statement. As a consequence, a number of emerging markets have experienced capital outflows and currency depreciation, with those with wider current account deficits and other macroeconomic balances being most vulnerable. Month to date in May, non-residents have been net sellers of South African government bonds to the value of 33.6 billion rands, contributing to the sharp increase in long-term domestic bond yields. At this stage, the likelihood of further sustained dollar strengthening is unclear. Apart from US domestic issues, it is likely to be influenced by geopolitical risks, trade conflicts, and expectations of changes in monetary policy in other advanced economies. In the near term, the rand is expected to remain volatile, with movements dominated by the changing assessment of these global trends. Domestically, an expected moderate widening of the current account deficit, a result of deteriorating terms of trade, could also weigh on the rand. The domestic growth outlook remains challenging, although still expected to outperform recent year outcomes. This is despite the possibility of a contraction in GDP in the first quarter of this year, following negative growth in both mining and manufacturing sectors. The bank's forecast for GDP growth is unchanged at 1.7% for 2018, but has been revised up from 1.5% to 1.7% for 2019. The forecast for 2020 is unchanged at 2%. The forecast remains consistent with a closing of the negative output gap by 2020, but at a slightly faster pace than before. The continued increase in the composite leading business cycle indicator confirms the upward momentum in the economy. The growth outlook is underpinned by strong recoveries in both business and consumer confidence. The RMB BER Business Confidence Index, while still below the neutral level, is increased by an unusually large 11 index points from 34 in fourth quarter of 2017 to 45 in the first quarter of 2018. This is expected to be supportive of higher growth in gross fixed capital formation, particularly by the private sector. The recent signing by government of the Independent Power Producer Program has added to the improved outlook. The FNB BER Consumer Confidence Index surged from negative territory to an all-time high in the first quarter, driven mainly by the positive reaction to domestic political developments. However, there is a general expectation that this move may represent an overshoot, and some correction is likely in the coming quarter. Nevertheless, consumption expenditure by households is expected to be the main driver of growth going forward, and the likely trend over the forecast period is stronger than previously expected. This is despite headwinds from the VAT and petrol price increases, as well as slow employment growth. Consumption expenditure growth is forecast to remain below 2% in 2018 and 2019, but to reach 2.5% in 2020, compared with 2.1% previously. Apart from improved confidence, this positive prognosis is supported by lower near-term inflation, lower interest rates, positive wealth effects, and real wage growth. Although growth in bank credit extension to households remains subdued and negative in real terms, there has been a moderate upward trend evident since the beginning of 2017, alongside an improvement in household balance sheets. Nominal wage growth trends remain more or less unchanged, and upward pressure on inflation from this source is therefore expected to persist. Nominal average wage growth is expected to be sticky around the 7% level over the forecast period. Real wage increases are expected to remain positive and in excess of productivity growth. The outcome of the public sector wage negotiations is still unclear. Unemployment trends remain a cause for concern. According to the quarterly labor force survey of Statistics South Africa, over the year to the first quarter of 2018, employment increased by 165,000, mainly in the informal sector of the economy. While unemployment declined from 27.7% to 26.7%, this was partly due to a marked increase in discouraged workers, underlining the lack of employment prospects. The MPC noted the relative stability of the inflation forecast, despite changes in a number of key assumptions. As expected, the bottom of the inflation cycle has been reached, and the trajectory of headline inflation is forecast to remain within the target range. The April inflation outcome was in line with the bank's short-term forecast and reflected a relatively moderate pass-through from the higher VAT and sugar tax. The full impact of the VAT increase may still be felt in coming months. In contrast with the previous meeting, the MPC assesses the risks to the inflation forecast to have moved to the upside. This change is mainly due to global developments. A key uncertainty relates to the outlook for the dollar, which has appreciated against most currencies. The spillover effects on emerging markets could become more severe in the event of further significant increases in US bond yields. Oil prices also pose an upside risk to the inflation forecast. Current spot prices are significantly above the levels assumed in the model. Furthermore, a slight moderation in prices, followed by a flat trajectory, is assumed in the coming 2 years. There may be a degree of upside risk to this assumption. Greater clarity with regard to electricity tariffs is expected in June, when NERSA is scheduled to respond to Eskom's application for an increase in the order of 30%. Our current assumptions are for an 8% increase from mid-2019 and a further similar increase in mid-2020. The possibility of an increase in excess of these assumptions pose an upside risk to our inflation forecast. The upside risks identified above are supply-side shocks. As we have noted in the past, The MPC attempts to look through the first round effects of such shocks and to react to second round effects. The evolution of inflation expectations and wage settlements will be important indicators in this regard. The growth forecast has improved moderately, mainly for 2019, but remains too low to make serious inroads in the unemployment rate. The risks to the forecast remain on the upside, but slightly less so than at the previous meeting. The weak first quarter growth outcome is not expected to derail the upward trend and does not yet reflect the renewed business and consumer optimism. Despite the longer expected trend in household consumption expenditure, there is still evidence of slack in the economy, and demand pressures in the economy are not assessed to pose a risk to the inflation outlook. In light of the change in the balance of risks to the inflation outlook, the MPC unanimously decided to keep the repurchase rate unchanged at 6.5% per annum. At these levels, the MPC still assesses the stance of monetary policy to be accommodative and appropriate given forecast inflation trajectory and the current state of the economy. However, with risks and uncertainties at high levels, the MPC will maintain its vigilance to ensure that inflation remains well within the inflation target range and will adjust the policy stance should the need arise. The implied path of policy rates generated by the quarterly projection model, the QPM, reflects one increase of 25 basis points during the final quarter of this year and a similar increase in mid-2019. Two further increases are indicated in 2020. The generated path remains a broad policy guide, and the extent to which the MPC follows it will be determined, amongst others, by the MPC's assessment of the balance of risks to the forecast. So at this stage, let us break and take questions that you might have. And as usual, please identify yourself and the media house that you are from. Say.
Good day, Governor. Just wanted to ask, it's Mfuna Kotoyana from Reuters News. Just wanted to ask, to what degree did the sell-off in the Turkish lira affect your assessment of the rand exchange rate and the possible knock-on effects onto inflation? And just a second question, a linked question, is are you concerned that there might be a repeat of the taper tantrum that was seen in 2014-15? Thanks.
Next door to you.
Alex Winning, also from Reuters. The first question is about inflation expectations. I see that there's a paragraph here that the longer-term expectations are now back above 6%, the top of the target range. To what extent are you concerned about that, and will that be one of the main things you look at when deciding whether there will be a rate increase? And the second question is about the possible contraction in first quarter GDP. To what extent are you surprised about that? Because many people have been talking about the new dawn in the economy with Mr. Ramaphosa coming and replacing Jacob Zuma in February. To many people, it will be a surprise that Q1 GDP could fall. So to what extent was that a surprise? Thank you.
Yes, ma'am.
Good afternoon, Governor. It's Anna Montero from Bloomberg News. Two questions. Just to confirm, the rate cutting cycle is over. And secondly, why is the Reserve Bank's oil price assumption so much lower than the current price prevailing? And how big is the upside risk to the central bank's price assumptions? Thank you.
One more? Nothing. Okay. Mfuneko, an assessment about the performance of the rand is based on developments in South Africa and other international developments that could affect South Africa. The lira seems to be responding to domestic Turkish issues. And in our assessment, the behavior of the lira didn't impact on how the rand performs. The rand story has been very much a dollar story rather than a rand story. And you can see that the dollar had strengthened across many other currencies. So that is how we would take it. Could this be a repeat of the taper tantrum of 2013, or do we see the risks? No, we don't think so. And the reason is that the US monetary authorities have communicated so well since the taper tantrum. And actually, in the recent past, we had a situation where there was a convergence between what the Fed dots were saying and what the markets were pricing in. Interestingly, recently, the market seems to be slightly ahead of the Fed this time. So you can't have a taper tantrum then coming from the Fed, given that the market seems to be ahead of the Fed. Alex, inflation expectations and whether we are concerned, be careful that the expectations that we refer to in the statement are not the surveyed inflation expectations. These are inflation expectations derived from the difference in bond yields between inflation-linked bonds and nominal bonds. It basically just tells us what dealers in the bond market are pricing in as what they see as future inflation in South Africa. They had fluctuated, yes, and they had jumped to around 6%. The 5-year break-even inflation is still below the 6%, but the longer-term ones are definitely above the 6%. And they fluctuate as a result of movements in the exchange rate and global developments and what you see in other bond markets. And that is a different set of expectations. The surveyed expectations, which are conducted by the BER, as we had said, from the last survey, they were still within the target, and they had actually declined towards the 5% level. We will see what the reading looks like in July. To the extent that the expectations formation process in South Africa is backward-looking rather than forward-looking, such a reading that comes out later, and if it is backward-looking, it would mean that it would look like the most recent inflation outcomes, and the most recent inflation outcomes are below or at the midpoint of the inflation target range. But let's see what the survey looks like when it comes out in July. Possible contraction in the first quarter is just that the high frequency data that we had seen from manufacturing and from mining seems to suggest that you could have a contraction in the first quarter of this year. Would we be surprised? Well, we wouldn't be surprised because the high frequency figures had actually shown that. But remember that whatever comes or whatever would have driven sentiment in the first quarter outcomes could have been developments that had taken place much earlier than that. Difficult as it is to link the confidence figures that had just come out to the actual outcomes of that particular quarter, the euphoria that you had referred to in your question. Bloomberg, you said your name again?
It's Anna.
Bitana.
Anna.
Okay. Is the cutting cycle over? It never started. We react to the business cycle, not to some interest rate cycle. The MPC determines the monetary policy stance based on recent developments and an assessment of what the outlook for inflation and growth would look like. Oil price assumptions, there is a story of big numbers here. Because what we have placed as our assumption is an average for the year. So much as the oil price has risen recently, because we are presenting an annual average, that gets reflected by the gets affected by the fact that earlier in the year you had a lower oil price. But as we say in the statement, that the oil price also remains a risk to the inflation outlook, as we do not know what the geopolitical situation would look like and what impact it would actually have on the oil price. Any other questions? Yes, Sisi.
Good afternoon. My question is unrelated to the Monetary Policy Committee. My name is Amkhalang Batam from Bloomberg News. Governor, we've recently, had reports that Bitcoin is planning to have its first ATM in the country. And if my memory serves me well, the central bank had a committee with some of the banks in the country to kind of discuss the implementation or possible regulation of Bitcoin in the country. I'm not sure if that report has been released yet, but if not, how is that going to be managed, since there isn't necessarily a specific underlying asset when it comes to Bitcoin?
Have you visited one of those ATMs? Mfuneko.
Hi, Governor. Just a follow-up. Do you believe the correlation between the rand and other EM currencies, has that increased or decreased in the last period? Thanks.
Any other? Ma'am?
Governor, another question on expectations. You've said before that you were worried about expectations being close to the top of the target range and you wanted to see them closer to the midpoint. So now they are coming down to 5, which is closer to 4.5. So two questions arising out of that. First of all, what do you think it would take to get them down to sustainably, I suppose, to the midpoint? And are you confident that if you were to get them down to the midpoint, that would translate into sustainably lower inflation? In other words, is the link between expectations and actual pricing behavior, are you confident that that would actually work? Thanks.
Thank you. Any other? Okay, if there isn't any, Mr. Minala, you will deal with correlations of the rand and the other emerging market currencies. And Mr. FinTech, you will deal with Bitcoin.
I think, Funeka, in terms of movements of emerging market currencies, there would be certain factors that are common to sort of determining their movements, which we see them sort of moving in tandem, such as the kind of period that we're seeing now with the resurgence of the dollar. That would tend to affect all of them. You see the rand moving in tandem. But there are, of course, periods where specific developments or factors to a particular currency would lead that currency maybe diverge from the group. As far as the rand is concerned, you would recall that last year, when there were particular concerns around policy and political uncertainty pertaining to South Africa specifically, we would have moved away from the general trend and underperformed the peer group. And when the situation turned and these confidence levels that we have seen and the change in investor sentiments towards South Africa on the back of what they saw as a renewed commitment to more sustainable policies, you then see the rand deviating from that and moving somewhat stronger than the peer group. So it changes from time to time depending on idiosyncratic factors. More recently, however, South Africa would have been moving somewhat stronger than the peer group.
Mr. Groep.
Thank you for the question. A couple of comments. First of all, we're busy gathering information. Obviously, noted the media reports because obviously we, amongst others, want to ensure or establish whether there's full compliance with the relevant financial surveillance or exchange control regulations. So that's the one issue. The second issue is, you're correct, we have established a fintech unit, and one of the projects that they are working on is to, in cooperation and collaboration with other regulators, is to draft a position paper regarding a proposed regulatory framework towards cryptocurrencies. And that is work in progress. And obviously when that is ready to be published, hopefully in the course of this year, that will give some guidance in terms of how we approach that. I think what is important to note is that we don't use the term cryptocurrency because it doesn't meet the requirements of money in the economic sense of a stable means of exchange, a unit of measure, a stable unit of value, etc. We prefer to use the word cyber token. And there's a number of regulatory issues, amongst others, that it doesn't, for example, fall within the definition of security in terms of the financial markets legislation. So there are a number of issues around that that we're busy studying, and at the appropriate time we'll comment on that. But as far as this particular AGM is concerned, we're busy collecting information so that we can assess what is happening in that regard.
Thank you. And then the last question had to do with expectations. Yes, it is still the preference of the MPC that the inflation expectations are anchored closer to the 4.5% level rather than away from it. And what would it take to drive the inflation expectations? There are a number of things that that would drive expectations down, but the most important one is a monetary authority that demonstrates that it is determined to get the inflation expectations to get closer to the 4.5%. And the monetary policy stance that we had adopted, we believe, is consistent with our desire to drive inflation expectations closer to the midpoint. And of course, if we do succeed in getting inflation expectations to 4.5%, that should translate into actual inflation outcomes actually getting to 4.5%. There is also the argument coming from the other side, which says that economic agents will believe that future inflation will be 4.5% and lower if the outcomes of policy results in inflation that is closer to the 4.5%. So in the earlier response, when I talked about the most recent inflation outcomes being below or close to the 4.5% level, to the extent that price formation in South Africa is backward looking, you would expect that people will say, oh, the most recent inflation is 4.5 and therefore don't ask for a price that is 6% higher. And that is how the thing, at least in theory, it should work. And elsewhere, where inflation expectations were driven lower, what had really worked had been that the actual inflation outcomes were lower. And inflation outcomes get lower because macroeconomic policy broadly drives inflation lower, because low inflation is good for growth. Low inflation is good for the poor. Low inflation is good for people who are living on fixed income. That concludes the proceedings of today. Thank you very much for your attendance.